Hey everybody, welcome back to the channel. If you're new here, please consider subscribing down below. I share a lot of research that I'm doing on ETFs, on dividend strategies, covered call strategies, things of that nature. If you stick with me long enough, in 10 years, you're going to see me retire on a very small portfolio of only about $250,000. Me and my wife are going to buy an RV. We're going to hit the road and we're going to show people that you don't need millions of dollars to live your dream. So if that sounds fun, leave me a like, subscribe down below, comment that you're here. I'd love to talk to you. And yeah, let's get to it. Today, I am talking about an overlooked area of investing that offers a decent dividend yield for a fairly safe investment. Now, it is in the fixed income arena. Now, when people hear fixed income, they think savings accounts, treasury bonds, bond funds, things of that nature. But this is a hybrid. So it has bond-like qualities with stock equity-like qualities as well. Any guesses? We are talking about preferred shares. Now, in the order, there's a pecking order when it comes to investing and what people are entitled to if a company were to go bankrupt, okay? The top tier is common stock, like what most of us buy shares of a company and whatnot. If that company goes bankrupt, mostly the common stock shareholder is entitled to nothing for the most part, usually. The bondholder is entitled to their first, they got their first dibs on anything if a company were to go bankrupt, because a bond is more like a loan. So the loan is secured by the assets of the company. That's what a bond is. And the common stock, there's no security there. You're the owner. So it's kind of, you ever hear the phrase, lender, be the lender, not the borrower, or be the borrower, not the lender, that type of thing. As a common stock shareholder, you are a borrower. If you own bonds in that company, you are the lender. So if you've ever been in a financial transaction, if you went to go buy a car, you go to a bank if you're going to finance the car, and they say, okay, we'll give you $30,000 to buy this car, but it has to be secured by the car. So if you default on the loan, they come get the car. It's kind of the same thing with common stock and bonds. Now, there is a hybrid to this, and it is the preferred stock. And what those are is in the middle. So it's common stock, preferred stock, then bonds. Now, preferred stock or common stock, this little chart here, common stock has voting rights, preferred stock usually not. The downside risk of common stock is as it can go to zero. The preferred stock, you have a little bit more downside protection. I mean, it's not a bond, so you're not protected, but in the pecking order, you're right in the middle. Now, for common stock, on the upside risk, you can participate as an owner of the company. You can participate in all of the profits and growth of that company. So your upside is huge. Preferred stock, usually none, because a preferred stock will usually issue a stock or a preferred share at a par value, similar to a bond, and they will agree to pay a fixed amount of a dividend every quarter. It will never grow. And normally preferred stocks stick around that par value because the companies can choose at their discretion to buy back those preferred shares at that par value. So if it issued at $25, they have the option to buy it back for $25. Now, of course, the preferred stock goes on the market and, you do the buys and sells, and a lot of times, it'll fluctuate. So you could theoretically buy preferred shares under par value and make money that way. But normally it is a fixed income investment. So you're going to get a fixed dividend every quarter that the preferred stock is available. Now, say they issued the preferred stock at 5%, $25 par value. Well, what could happen is if you own that, they're going to pay you the 5%. But if interest rates drop, they can buy back the preferred shares that you own at 5% for par value, and they could go out and issue new preferred shares at the lower interest rate. So that's one of the disadvantages, I guess, but you still get that par value. So the next one is reliability of investment income. The common stock is less because you are actually the last one to get paid as far as a dividend is concerned when you own common stock. The bondholders get paid first because they're the lender, they're the bank. The preferred stock gets paid second because they're next in line right above the bondholders. And then the common stock gets paid third. So another thing that they can do is they cannot miss a bond payment. So companies, if they miss a bond payment, they're in like deep doo-doo. They could suspend the preferred payment, but they would have to cut the common payment first. So if you see a preferred stock whose common stock has cut their dividend, you need to keep a close eye on the preferreds. Now, some preferreds, this is getting complicated. I should have did a longer video or more detailed one. But some preferreds, they can suspend the dividend on the preferred, but some of them have a feature that is cumulative. It's called cumulative. That means that even if they didn't pay that preferred dividend that month or that quarter, they'll have to make it up down the line sometime. So this is another feature of preferred stocks. Now the price volatility, common stock is going to be a lot more price volatile. Preferred stocks, like I said, usually stick around that $25 par value. Sometimes they'll drop a little bit or even go above depending upon the demand of the preferred stock and its income. Now there's an ETF that tracks some preferreds. There's a few of them, but the one I'm going to go after here today is issued by Invesco, and its ticker symbol is PGX, and it is a monthly pays about a 5% yield and pays it monthly. Now, like I said, this is not a replacement for a a bond fund or a savings account, but I mean it's fairly stable. If you look at it over 10 years, you can see the price has gone up 5% over 10 years, right? It's fairly flat. It stays around that $13 to $15 range usually. It did get a little hammered here in March, just like everything else did. But it is, if we go to its dividends and we'll go to the dividend history, it pays a consistent dividend. Now it has gone down from the highs, but it's not because it's cut. It's because as interest rates drop, they can issue preferred shares at lower interest rates. So it's not like they're cutting the dividend. It's just the nature of the beast with how interest rates work. Like I said before, they can buy back preferred share and reissue preferred share if they can get a lower interest rate. It's just like refinancing a loan in a sense. So this one is PGX. It is a preferred portfolio, and most of these are corporate finance bonds, or finance preferred shares, I should say. And a lot of them, there are some AT&T bonds in here, or I keep saying bonds, preferred shares. But they're mostly banks. See, Citigroup, 6 7/8%, PNC Financial, Wells Fargo at 4.75%, JP Morgan, that shows 0. There's some different styles of preferred shares. Another Bank of America, TPC, another Bank of America. So they hold 287 preferred shares in this fund. So it would make it fairly stable if I were to buy one, a preferred ETF. This would probably be one I look at. I think banks are a lot more healthier now than they were in 2008 when we had the financial debacle. And you can see preferreds got hit in 2008. This thing got hit by like 50% or more. But I don't see them being as unhealthy as they were then. And you can see since 2010, it's stuck around that $13 to $15 range. It's consistently paid a dividend, and just another avenue to where you can park some cash possibly and collect a decent dividend from it. Now, what has it done with the growth of 10,000? I compared it to QILD just because. And since 2013, PGX just slightly beat QILD in total return. PGX since 2013 returned you 6.5% with dividends reinvested. QILD at 6.3. So just giving you another option. If you have any questions, let me know. Put them down below. Have you heard of preferred shares? Have you invested in a preferred stock before? Let me know. Give me a comment down below. I'd love to hear what your experience is in preferred shares. And thanks for stopping by. Appreciate it. You guys have a great day, and we'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.